Well, all right, here we are having a quick discussion about living benefits today. And I want to see if I can locate that PowerPoint presentation. Here we are. All right, go ahead and get that slideshow started. All right, here we are. So, understanding living benefits. Now, in previous videos, we've discussed lightly a little bit of information about living benefits. But with this particular presentation, we're going to go in a little bit more detail. Um, just kind of like a preamble to this discussion, living benefits are huge. So back in the day, you'd get your life insurance policy, and the only one that would truly benefit from your life insurance policy would be your beneficiary or your beneficiaries. So regardless of the face value of your life insurance policy, you never get to see any of that money, but your family does do better after you pass, which is, what we want. We want the family to do better. Every generation is supposed to be better, but what happens if you actually need some of that money before you actually, answer the Lord's call? And that's the discussion we're going to have tonight. The way life insurance used to be is no longer like that anymore. There's been some significant strides in how well life insurance benefits you and your family for a better living. So, let me actually got a little bit too far there. So let me see. Escape that. Let's see. There we go. That's what I wanted to do. All right. So for the agenda, we're going to talk about the evolution of life insurance, the types of life insurance, benefits of life insurance, and a case study, and of course, the question and answer period. So looking at our agenda, we were going to talk about the evolution of the telephone. Now, you guys remember back, well, you might not remember back in 1885. I sure as heck don't. But back in 1885, you'd have this little cup that you put on your ear, and you'd wind up this thing, and you'd actually call some switchboard or something to connect you. And then back in the early 20s, you had that phone that was similar to the one back in 1885, but now you have the little rotary that's, you got, I mean, it took forever for you to do that. I mean, and then if you make a mistake, oh my God, you got to start all over. It was horrible back in '65. It was the same type of phone, a little bit better, but it still sucked. And then early '80s, mid '80s, we had this. We call it the brick, the cell phone that was the brick, and only certain people had it. And you always saw the people that drove like some of those old Mercedes or some kind of a convertible with this brick cell phone. It just looked crazy. In '90s, we had the brick became smaller, and in the early 2000s we had a lot of those texting phones that already had the buttons on it and everything. And then of course there's the advent of the smartphones, which pretty much does everything. Oh my God, it's insane. So if you can look at the some of the gadgets that you have in the phone, I mean, you got a glass touch screen, but look at all the apps. That's a long way from with the rotary phone to having, something like this. So with everything that we started out with, as time marches on, things get better. Products are supposed to get better, and insurance is no different. So let's look at the evolution of life insurance. So, back in the day, there was pretty much only term that was available. Term life insurance, anywhere from 10 to 30 years life insurance, and once the insurance term period was over, so was your coverage, unless you were going to be paying some ridiculous premiums right after that. But then in the 1950s, some clever person came up with the whole life policy, where you actually start uh, adding cash value or cash accumulation to your life insurance policy. Now, the life insurance policy is considered a permanent policy, meaning you actually are buying insurance, and this insurance is supposed to protect you for the remainder of your life. And with that cash value, as you're accumulating that cash, you actually earn an additional 3 to 4%, which is up to par with inflation. So whole life is a big deal for a lot of people. And then in the '70s, you started getting what is called a universal life insurance policy. That's pretty flexible. You still get about 4 to 5%, but there was a lot to the applications that you can do with that. Then back in the '80s, we have what is called a variable universal life insurance policy. And that has significant amount of growth, anywhere from 9 to 10%. But it's variable. One year you can have 1%, one you could have 10%, another year you can have less. But when you look at what we have in the 90s, where we have the index universal life insurance policy, you have a guaranteed 7 to 8% on average with the index universal life insurance policy. And as we go a little bit further along, you'll learn a little bit more about that. So let's look at the bottom of this pictorial where it says the death benefit covers, protects your family basically. But the living benefit with the newer insurance policies, with the added living benefit, I should say, it protects you as well, if something were to happen to you. So we're going to look at a little bit of an analogy. So term life insurance is like renting a house, right? It's basically renting insurance for a certain period. Then you have the permanent life insurance, which is basically owning your house. You're owning the life insurance policy. So you're owning insurance, type of insurance policies, a whole life, universal, and variable life insurance policy. So if we were to do a comparison between the two types of life insurance policies, term versus permanent, your coverage is usually from 5 to 30 years. Typically provides no cash value, but offers a lower premium. And this is a really, really big deal for, if you're a younger person, you might not necessarily need it, but I mean, it's very inexpensive. Or if you're a parent and you have it on one of your younger people, one of your children, it's really low cost. And, say they're doing something crazy, like they're a skydiver or something. It's a big deal. And it often provides protection for specific times of need, such as a mortgage or a child's college tuition. And there are some really great policies that are available for that. Whereas a permanent policy is designed to provide coverage for individuals' entire life. You build cash value that accumulates over the life of the policy, and the cash value can be assessed if needed for any reason, and can provide guaranteed income after retirement. So you can actually have your life insurance structured to where you can pay it up. And at a certain age, whether it be 70, 72, 74, you start having distributions of that life insurance policy as a form of income. Now, we've had in previous videos discussed how Social Security was never intended to be a full form of income for you. So being able to have the supplemental income coming from your life insurance policy is huge. So we're looking at the traditional life insurance that a lot of you might remember, back in the day where you would get a life insurance policy and your family gets the money. Now, it's really nothing wrong with that. Anybody that, maybe I should be careful with that. But if you get a life insurance policy, you got the life insurance policy because you expected that you're going to be, expiring, and you wanted to be able to take care of your family after God calls you home. But today it's a little bit different. With the advent of living benefits, you still have the death benefit. Your beneficiary still gets the money. But what happens if you just get sick? What do you do? Sometimes medical insurance just doesn't cover everything. As a matter of fact, a lot of people that have gone bankrupt, of those people, 80% of them actually had medical insurance. So being able to have supplemental income coming from your life insurance policy is huge, especially if you have some form of terminal illness. You're basically going to die within the next 24 months, a chronic illness, a critical illness, or you have significant medical bills that you need to cover. You can protect yourself from that, or you can just use it as income replacement while if you recover. There's been countless stories where someone might have been given a terminal illness and all of a sudden they beat it, but they still got the check from the insurance company, hundreds of thousands of dollars. So that's a big deal. So some of the top causes of death in the United States back in 2018, I think I should probably mention, heart disease, 635,000, cancer, 598,000, traffic accident, chronic lower respiratory diseases. And right now with COVID-19 out there, the chronic lower respiratory diseases are, and that along with influenza a little bit further down the road there, that's becoming a big deal for a lot of people right now, because they're starting to realize that even though they've been healthy day in, day out, they might have gotten the flu and they might have beaten it. A lot of the challenges that we're having health-wise today is really making people think, well, you know what, maybe I need to get my house in order. And that's a great way to think. And getting a life insurance policy while you're still healthy is a sound decision, because if something were to happen, Lord forbid something were to happen and you were to get ill, and the insurance company, your medical insurance companies, they probably won't cover it because they're inundated. You know, even though, let's just say they actually had a heart and they cared. Right now, you have so many people filling up the hospitals that it's really difficult. So the best thing that you can do is make sure you have the income to be able to take care of you, even if you have to stay home. So you're looking at stroke and Alzheimer's and nephritis and suicide. People are still, you know, very unhappy right now. They might have lost their jobs, and you know, some of the challenges that people face, you know, sometimes come from, you know, having not having enough finance or financial support or financial stability to be able to help you take care of your family. So the new policies today, back in the day, it might have only just been a death benefit, but now you have chronic illness, terminal illness, critical illness, which are all living benefits, plus the death benefit that you already had. And inside that policy, you're also accumulating cash that you can use as a retirement income source later on in your life. And all that can all be packaged into one nice, pretty policy. So we start talking about different types of terms. So if you look at competitive advantages, a lot of term policies, 18 living benefits triggers, accelerate as much as 90% of your death benefit up to $1.5 million. Some of them are $1 million or whatever. They're included through, they're free. They don't cost anything. No knockout questions. So a living benefit is added, the riders are added to your policy regardless of whether you are interested or not, and chances are you're interested. So non-medical, face amounts of $300,000 or less, age 60 or less, you can just go ahead and get the policy. Now, this is huge because if you're under 60 years old right now and you wanted $300,000 in life insurance coverage, a term policy, you can get that without a medical exam. How awesome is that? Especially because there's no testing being done right now with this COVID-19 situation. That's huge. So the product details, you know, you start looking at various term policies up to 30 years. Face amount above 61 will be anywhere from $50,000 to $100,000. Your ages are from 18 to 80 for 10 years, up to 18 to 55 for 30 years, and you can convert them. So the reason why converting is a big deal is that money that you've been putting into those premiums can actually be attributed to your new permanent policy, and all you have to do is just pay the new premiums as you continue to take care of that policy. So premium building, non-medical, $50,000 to $100,000 standard and rapid standard, $100,000 to $300,000 is preferred, and standard and rapid standard. And so fully underwritten, that means you get the medical exam and everything. If you're getting a medical exam and everything, they're looking you over, they know exactly what's going on with you. They know all the medication that you're taking. You can get anywhere from $300,000 to $1 million. And for $1 million and more, what you have available is preferred plus, preferred, and select. Standard, of course, as preferred plus, the premiums are really, really expensive versus standard, they're a little bit more expensive. So qualifying conditions for terminal illness, life expectancy of 12 months or less, qualifying condition for chronic illness, severe cognitive impairment or inability to perform 2 of 6 average daily living duties. So dressing, toileting, transferring, continence, eating, or even bathing. So up to 50% of the death benefit with $1 million max. So if you have a $1 million policy, you can actually get $500,000, up to $500,000 if you cannot eat by yourself, or you cannot go to the bathroom by yourself, or you have a trouble bathing, or you have trouble dressing. That's $500,000 for you. And you can very well recover from whatever the illness is, but it'll be awful helpful if you get a check that's going to support you and supplement your income if you can't go to work. So qualifying conditions for critical illness, invasive life-threatening cancer, stroke, major heart attack, end-stage renal failure, major organ transplant, ALS, blindness, paralysis, major Burns coma, aplastic anemia, benign brain tumor, aortic aneurysm, heart valve replacement, coronary artery bypass, graft surgery. So anything that's related to these different types of illnesses, you could very much qualify for that 50%. So the living benefits payments. Now, there's a couple of schools of thoughts on this. Some people might want that big, huge lump sum, or they might want to annuitize it or putting into a lump sum or getting in payments. So if you have a critical or terminal illness, you can get the lump sum. If you have the lump sum, if you have a chronic illness, you can get lump sum or have it paid out to you in installments. So, living benefits may accelerate less than the amount available, up to 5 accelerations. 10% of death benefit remains. It has to, because the policy will not be enforced if you don't have 10% of death benefit left over. The max living benefits for all Emeritus policies is $1.5 million. So, universal life insurance issue. Okay. So, this doesn't look like something I want to put in my presentation. 18 living benefits triggers for your permanent policy. Lean approach, transparent benefit amount, remaining death benefit. Policy can still meet original goals. Qualifying conditions for terminal illness would be life expectancy of 12 months or less. Eligible to receive up to 75% of death benefit with a maximum of $1 million paid as a one-time payment. Chronic illness is severe cognitive impairment or inability to perform 2 of 6 average daily living duties: dressing, toileting, transferring, continence, eating, or bathing. Up to 50% death benefit, not to exceed $1 million. Qualifying for critical illness, everything I said in the previous slide. Up to 25% of death benefit, $250,000 max. What happens if a client gets sick? A male 40-year-old, $6,000 payment, premium payment, annual premium, approximately $400,000 policy. Client gets sick with a critical illness at age 60, 20 years into the contract. Problem: how does the family get through this crisis without sacrificing the 20-year plan they've diligently executed in preparation for retirement? Living benefits payments may accelerate less than the amount available. So a $300,000 policy, critical illness claim, $25,000 first acceleration. Critical illness, $25,000 first acceleration, another acceleration at $50,000. Chronic illness claim, 50% or current death benefit. In this case, would be $150,000 of the 5 accelerations. Max living benefits for all is 1.5. Okay, so your legacy protection for beneficiaries, even if living benefit claim. Protect family income and an emergency fund. Oftentimes is lost at work for both the husband and wife if no one needs to care. Time to take your partner to take your partner to and from their appointments and doctor visits, out-of-state treatment, blah, blah, blah. Protect retirement savings and accounts. You help clients save for retirement. Clients have IRAs, Roths, 401ks, assets under management. If a client gets seriously ill, are they continuing to contribute? Do they pull money out of the accounts to pay for expenses? Protect retirement savings and accounts. Consider at minimum having each client obtain term life insurance with living benefits up until the age of retirement. Should that critical illness hit when the client is in the accumulation phase, the living benefits paid out from the life insurance policy could allow the client to keep assets in retirement accounts under management. A $250,000 term policy with living benefits could mean $125,000 while the client is alive. How helpful would that be? So living benefits on kids and grandkids. Consider permanent life with living benefits on minors. Provides a lifetime of protection, protects insurability, cash value, critical illness, and even long-term care. Focus on the hot button. Know your client. Clients 20 to 40 will not care about long-term care features on a life insurance policy. They will care about the critical illness features. Clients 40 to 55 will care about both critical and long-term care features. Clients 55 plus will care about long-term care features. I just did a couple of clients, had a couple of clients that I was working with, and both of them, interestingly enough, were 54, and that's spot on. They really do care about the long-term care, and they just happen to be women. And you guys probably already know that women and men have different needs as they get a little bit older. So that long-term care is a big deal, especially if you're someone who's unmarried, living alone. So we have what are called buy-sell agreements. Few businesses have a current buy-sell agreement. If funded, it is usually just with life insurance. Disability buyout insurance is best to fund if disabled. Consider life insurance with living benefits, including critical illness and chronic illness, long-term care. Term for critical illness and permanent for chronic. Key employee. Businesses often put life insurance on a key employee whose untimely death could harm the business. CEO, vice president, top salesperson, chief operations official, officer. But traditional life insurance only pays at death. Show living benefit life that could pay benefits if the employee has a critical or chronic illness. Healthcare benefits. If your client has a health issue and is denied benefits, for example, the treatment is considered experimental and thus not covered, tap into the living benefits of the life insurance policy to obtain the money to pay for that care. How about that? Who else should get life with living benefits? Life happens. Living benefits writers, low-cost source for lump sum funds for likely life events. And with that, I'm done.